Today we will focusing on Chapter 5, Federal Reserve. Today's agenda is the transfer of funds from savers to government, the role of the Federal Reserve, expansion of money and credit, monetary policy, fiscal policy, inflation and deflation, and the recession, definitions, and wrap up. As remember, this is the players in diamond. We have financial institutions, savers, borrowers, and financial market. Now we will see Federal Reserve, central bank. Um, Federal Reserve has impact on supply and money and credit, and Fed supervises the depository institutions. Also, it affects the financial market and investors, individuals, mutual funds, and foreign governments. The the purpose of the Federal Reserve is to help achieve the stable prices, full employment, and economic growth through the regulation of the supply of credit and money in the economy. And the changing supply of money and credit to achieve these three goals is called monetary policy. So monetary policy is the management of the money supply for the purpose of maintaining stable prices, full employment, and economic growth. The Federal Reserve has several tools for monetary policy. The primary tool is open market operations, while secondary tools are the discount rate, reserve requirements. Federal Reserve uses these monetary tools to expand or contract the supply of money to pursue the economic goals of prosperity with full employment and stable prices. When the Federal Reserve seeks to increase the supply of the money and the credit to help expand the level of income and employment, that is called an easy monetary policy. The process of executing such a policy is often referred to as quantitative easing. When the Federal Reserve seeks to contract the supply of money and credit to help fight inflation, that is referred to as tight monetary policy. While controlling the supply of money, credit is the primary role of Federal Reserve, it also serves other functions. These include supervisory power over depository institutions. The purpose of the supervisory power is to protect depositors from poor financial management by individual banks and includes enforcement of bank regulations and periodic examination of banks. And the Federal Reserve also serves a depository institution for member banks, the U.S. Treasury, and foreign central banks. The bank deposits their reserves with the Federal Reserve, and the Treasury may deposit funds such as tax receipts in the Federal Reserve banks. Foreign deposits arise as the result of international monetary transactions. Of all the different deposits, the most important are the reserve of banks. By altering their reserves, the Federal Reserve is able to alter the supply of money and ability of banks to create loans. It's through the power of the Federal Reserve to create and destroy banks' excess reserves that credit is eased or tightened. So next topic is the structure of Fed. The power in the Federal Reserve is concentrated in a board of directors, which consists of seven people, including chairman, and the seven people appointed by the President of the United States with the confirmation of the Senate. The appointments are for 14 years, and the terms are staggered so that one new appointment is made every 2 years. The chair of the board of governors is usually the major spokesperson for monetary policy and may act as an advisor to the president on economic policy. The power of the board of governors manifests itself in several ways through its power of appointment and control of open market operations. The country is divided into 12 districts with the Federal Reserve Bank in each district. Each district bank is managed by 9 directors, 3 of whom are appointed by the Board of Governors. The remaining 6 directors are elected by member banks and they represent the member banks' industry, commerce, and agriculture. By dividing the nation into districts, it's possible to have an individual reserve bank perform specialized financial services pertaining to its region. For example, the financial problems of rural regions may differ from those of urban areas. Decentralizing the central bank into districts permits a more flexible approach to regional financial problems. Since the city of New York is the financial center of the nation, the district bank in New York is the largest and most important individual reserve bank. The last component of the Federal Reserve is Federal Open Market Committee, which has control over open market operations. Because open market operations are the most important tool of monetary policy, this committee is a powerful component of the system. The committee consists of seven members of the Board of Governors and 5 presidents of the district banks. The president of the New York District Bank is the permanent member of the committee, while the 4 remaining positions rotate among the district bank's presidents. By voting as a block, the Board of Governors has a majority on the committee and has control of open market operations. So in summary, the important components of the Federal Reserve are first, the Board of Governors, second, the district reserve banks, third, the member banks, fourth, the Federal Open Market Committee. This structure is summarized here in this figure. Although the President of the United States appoints the Board of Governors and the member banks own the Federal Reserve, the real power rests with the Board of Governors. It has this power because it appoints 3 of 9 directors of district reserve banks and composes the majority of Federal Open Market Committee. And third, has a regulatory authority over the commercial banks. Thus, the Board of Governors is individually the most important part of the Federal Reserve System. The expansion of money and credit. One way that the Federal Reserve affects the supply of money and credit is through its impact on the reserve of banks, which alters their lending capacity. A small change in banks' reserves can produce a much larger change in the money supply because of the fractional reserve system. Understanding the potential impact of monetary policy requires understanding how the banking system expands and contracts the supply of money and credit. That is, understanding how fractional reserve banking system alters the supply of money. A bank's ability to lend comes from a variety of sources. These include individuals who deposit funds in checking accounts, investors who purchase certificates of deposits and bonds issued by the bank, and the equity investors who buy the stock sold by the bank. If cash is deposited in a bank, it has additional funds to lend. If foreign funds flow into a bank, it has additional funds to lend. If the Federal Reserve buys securities and the proceeds are deposited in a bank, the bank has additional funds to lend. While an individual bank can lend only what it obtains from its sources of the finance, the aggregate banking system can expand the supply of bank and credit. So Fed controls expansion and contraction of the money supply through reserve requirements, discount rate, and open market operations. Reserve requirements shows the importance of excess reserves, and it enables fractional reserve banking system. Discount rate is the interest rate charged banks for borrowing reserves from the Fed, and the third operation is the open market operations, which is buying and selling government bonds. This is the most important tool for monetary policy, especially in the short run. So the process of loan creation will be illustrated under the following assumptions. First, cash is always deposited in a demand deposit. Second, banks hold no excess reserves. All excess reserves are loaned. And third, there are sufficient borrowers to consume the excess reserves of the bank. So let me explain the process of loan creation. Before that, same, the reserve requirement is the percentage bank must hold against deposit liabilities. Excess reserves shows the amount above required reserves. And changing commercial banks reserves leads to multiple expansion and multiple contraction. So let me explain the process of loan creation. So consider what happens when $100 is deposited in a checking account. The $100 has been removed from circulation and replaced by the demand deposit. After the bank receives the $100 cash deposit, the $100 becomes part of the reserves of the bank. These $100 reserves, it is divided into two categories. The first is those reserves that must be held against the demand deposit, the required reserves. And the second, those reserves in excess of the reserve requirement, which are called excess reserves. If the reserves requirement is 10%, then $10 of the $100 cash reserve is required and $90 is excess reserve. And these excess reserves are important because commercial banks use these excess reserves to acquire income earning assets such as loans and securities. Depositing cash in a commercial bank that gives it the ability to create loans because the bank obtains a resource that it may lend excess reserves. Banks do not lend and cannot lend their deposit liabilities. If the bank grants a borrower a loan of $90, what effects will this transaction have on the depositors and the banks and the borrower is it expands the money in the system. So in summary, the loan made possible a purchase by the borrower, and thus the seller has made a sale that may not have occurred without the creation of the loan. And the goods have flowed from the seller to the buyer. When the seller deposited the payment in a commercial bank, this caused reserves to flow between the seller's bank and the borrower's bank. So what is the net effect of this transaction on the money supply and amount of credit? Both have increased money supply and amount of credit. How? There are 190 in demand deposit, in initial deposit of 100 in the first bank and the new deposit of $90 in the second bank. There has been a net increase in money supply of $90. This is $90. This $90 increase came through the process of loan creation. There is now $90 in a new credit. The act of depositing cash in a checking account lead a net increase in the supply of money through the process of loan creation. So that the process of loan creation is not limited to initial expansion of $90 for the second bank now has a new deposit. So what is the required reserve for the second bank is 10%, and $9 is required reserved for the second bank, and $9 minus $90 minus $9 is the $81 is the excess reserve. So for the excess reserve for the second bank is $81. It can again goes loans or securities. So since the reserve requirement is again 10%, the bank must hold in reserve only $9, and it received $9 in reserves from the first bank when the check cleared. Thus, $81 of these reserves are excess reserves that the second bank may use to purchase on income-earning assets or grant a new loan. If the second bank grants a loan of $81, it creates a new demand of deposit of $81. The borrower then purchases goods and services and pays for them with a check drawn on a new demand deposit. The $81 check then is deposited in a third bank in reserves from the second bank, and the third bank divides these reserves into required reserves. $81 multiply 10% is required reserve, which is $8.10, and excess reserve is 72.9. The third bank now has the capacity to acquire income-earning assets and create new loans, again, loans and securities. So what is it goes to 0, and cumulative required return goes to 100, and cumulative new credit goes to 900. How can we find the final value of cumulative new credit, which is 900? Let's find out. Okay, let me clear the page. Okay, the process of a loan creation is a very simple calculation. Change in excess returns divided by reserve requirements is change in money supply. So we have initial $90 in excess returns. If you go back, we have $90 excess returns here. And if you divide it by 10%, you will end up the change in money supply in the financial system. Also, withdrawals results the money supply contraction, the reverse effect. So markets for reserves, the federal fund markets, banks borrow and lend excess reserves, and the federal fund rates is the interest rate charged between banks on overnight loans of reserves, and discount rate is the interest rate Fed charges banks for the borrowing reserves. The other topic is the tools of the monetary policy. The Federal Reserve has three primary tools for affecting the reserves of depository institutions. The first one is, as we looked at the required reserve requirements, discount rates, and open market operations. The reserve requirement is the increase of the reserve requirement can be explained the increase of the reserve requirement will immediately decrease the bank capacity to create loans, and it's infrequently used. Okay, the tools of monetary policy. The other tool is the discount rate, which is the change in discount rate is intermittent, and Fed established the target rate, And the current federal funds rate as of May 18th, 2020 is 0.05%. And the Fed uses open market operations to achieve target rate. So mainly the discount rate is the interest rate charged banks for borrowing reserves from the Federal Reserve, and this is the second tool for the monetary policy. And as you see from this graph, federal funds target rates. This is just fund rates through different chairs, Fed chairs, and yeah, this graph is for the poll worker. The Fed rates, the target rate is higher than the Alan Greenspan, and the Alan Greenspan target rate is higher than Ben Bernanke and Janet Yellen. But now Jay Powell has higher interest rates. It's not related. It's just that it's not related with their heights. No. The third tool of the monetary policy is the open market operations. And let me explain what is the open market operations. The open market operations is the buying and selling federal government securities. This is the most important monetary policy. It's the fine-tuning. It has the fine-tuning effect. And yeah, and first mechanism is to expand the money supply. The Fed buys government securities. This is Fed can buy securities, buying securities and giving cash to the system. So paying for securities put reserves into the banking system and purchases reduce interest rates. The second mechanism is the contract, the money supply. The Fed sells government securities. Fed can sells government securities and reduce the money supply. And sales increase interest rates. Receiving payments for the securities removes reserves from the banking system. And what is this monetary policy tool used for? This tool helps the Fed promote stable prices and maximum employment by changing the supply of reserves in the banking system, which influences interest rates and the supply of credit. For example, expansionary monetary policy is like tapping the accelerator. The Federal Open Market Committee wants interest rates to decrease. The trading desk is directed to engage in open market operations, including purchase of the government securities. By purchasing the government securities, they're giving cash to the system, and this injects reserves into the banking system, and the banking system is full of cash. This puts downward pressure to the federal funds rates and other interest rates, encouraging people borrowing loans, auto loans, mortgage loans, or other types of loans, and their consumption level is getting higher and higher. This accelerates the economy. And contractionary monetary policy is like tapping the brakes. The Federal Open Market Committee wants interest rates to increase. How they can do that? They can sell government securities, and this puts upward pressure on the federal funds rates and other interest rates, encouraging saving. The the interest rates are getting higher and higher, the consumption level, interest rate getting higher, and consumption level is getting lower. The other topic is the impact of fiscal policy on credit markets. Even though the Federal Reserve can affect the supply of money and credit in the economy, it does not have complete control over them. There are forces beyond its control that can affect the supply of money and credit. One of these forces is the fiscal policy of the federal government. So fiscal policy is the federal government's taxation, spending, and debt management. So what is fiscal policy? Fiscal policy is taxation, expenditures, debt management by the federal government. Like monetary policy, fiscal policy may be used to pursue the economic goals of full employment, price stability, and economic growth. Like monetary policy, fiscal policy can affect the supply of money and the capacity of the banking system to lend. So, what is deficit? The deficit is disbursements of exceeding receipts. So, the government spending exceeds revenues. For example, in 2016, U.S. budget deficit is $587 billion, which is close to 3.2% of GDP, and it's getting higher and higher right now. And in 2019, the budget deficit compared to the GDP is 4.7%. So what is surplus? Surplus is the government revenues exceed spending. If you look at the U.S. budget deficit figures, you will see the deficit in 2019, and it's getting lower and lower. And then after tax cuts and the Job Act become law, and the deficit getting higher and higher. So this is another chart, shows deficit. In 2019, the deficit level is in the highest point. It's getting lower, and then currently the budget deficit is rising. So what could be the source of funds to finance this deficit? The government revenue minus spendings shows the deficit or surplus. So how can the government finance the deficit? The first source is commercial banks. The second one is non-bank public or Federal Reserve or foreign credit markets. So borrowing from foreign sources. So the federal government may also borrow abroad, in which case the securities are sold in foreign countries. When the funds from the sale are deposited in domestic banks, the bank's reserves are increased. From a domestic perspective, borrowing from abroad has the same impact as borrowing from the Federal Reserve. The money supply and reserves of domestic banks are increased. The money supply and reserves of foreign banks, however, are decreased. So if the funds are spent abroad, the money flows back out of the country, so there is no netting impact on the domestic monetary system. So just as selling securities abroad causes a domestic expansion in monetary supply and the reserves of banks, retiring debts held abroad contracts the domestic money supply and the reserves of banks. So if you look at the figure here, The impact on the money supply and the bank's reserves of these cases is summarized. Of these possibilities to finance a deficit to repay existing debt, the greatest impact occurs when the transfer involve the Federal Reserve or foreign investors, because the domestic money supply and reserves of the banking system are affected. Financing a deficit by selling securities to the Federal Reserve or abroad has expansionary implications. Retiring debt held by the Federal Reserve or foreign investors will have the opposite effect. So as you see, case 1, case 2, and case 3 and case 4 shows the possible impacts in change in money supply, change in total reserves of banks, and change in excess reserves. For instance, in case 1, borrowing from general public, there is no impact on change in money supply or total reserves of banks or excess reserves of banks. But in case 3, borrowing from Federal Reserve, it increased the money supply, it increased total reserves of banks, and it increased the excess reserves of banks. Another topic in this chapter is inflation and deflation. The inflation is the general increase in prices with special emphasis on increase in consumer prices. How can we measure it? We measure inflation with CPI, Consumer Price Index. So it measures the rate of inflation. Here I show the percentage change December to December rates. For instance, in 2015, the CPI, the Consumer Price Index, is 0.7%, but in 2019, the CPI is 2.3%. So what does it mean? It means higher inflation is beneficial to borrowers, but bad for creditors. How can we fight with inflation? The Fed can fight the inflation by contracting money supply, raising interest rates, and raising taxes by fiscal policy. This is monetary policy. First two, and raising taxes is linked to fiscal policy. What is deflation? Deflation is the general decline in prices and opposite impact from inflation. And unexpected deflation hurts borrowers and help creditors, associated with higher levels of unemployment. And the recession is the period of at least 6 months during which the economy experiences increased unemployment and negative growth. So let's solve a problem. You invest $1,000 in a saving account in the beginning of 2014. Interest rate is 0.5%. How much you have at the end of 2015, and considering CPI was 0.8% in 2014 and 0.7% in 2015, how much you should have at the end of 2015 just to keep the purchasing power of your money. And the last section is having a saving account a good investment? What are the advantages and disadvantages? Pause the video here and try to solve these questions, and I will solve these questions. For the section A, in order to it asks how much you have at the end of 2015, So the interest rate is 0.5%. That means 0.05. And you have 2 years. How much you have at the end of 2015? Yes, you have 2 years because it's at the beginning of 2014. It's at the end of the 2015. You have 2 years duration. So 1 plus the interest rate, 1 plus the interest rate, multiply principal, which is 1,000, interest rate. A simple calculation, you will have $1,010. The second question asking how much you should have at the end of 2015 just to keep the purchasing power of your money. So to keep purchasing power every year, you have your principal. This is inflation. So you have to adjust your purchasing power looking at inflation. If inflation goes up, you need to adjust your purchasing power. So at the end of 2014, your principal, first you have the principal amount is 1,000. The inflation is 8%, and at the end of the 2014, you should have at least $1,008. Again, similar calculation, and at the end of 2015, at the beginning of 2015, you have in the beginning of 2015, you have $1,008, and the inflation rate for 2015 is 7%. So you need to have $1,015 in order to keep a purchasing power, your purchasing power. The third question is saving account is a good investment. What are the advantages? So it depends, because yes, if you are risk averse and you may need to this amount in the short term, it makes sense, but it doesn't make sense if you want to invest for a long term and you can tolerate some risks. So advantage is this is the saving account is risk free up to $250,000, and the disadvantage of the saving account is it's not even covering the inflation. So to wrap up, we covered the goal of the Federal Reserve and the process of loan creation, the primary goals of monetary policy, how open market operates, how the open market operations work. So please read your notes, PowerPoint slides, chapter 1, 2, 3, and 4, 5, and complete might have exercises, quizzes, video reviews, PowerPoints, and flashcards. Plus, please read the book. Thank you for your attention.